Welcome back. Whether you are prepping for a major strategy meeting, trying to catch up on the absolute whirlwind of global finance, or you are just insanely curious about where the world is heading, you are in the right place.
Yeah, you really are.
We have got a deeply customized deep dive for you today, and we're broadcasting this on Saturday, February 28, 2026.
And it is a wild day to be looking at this specific stack of research.
Oh, absolutely.
We are currently sitting in the middle of a massive paradox in the global digital economy.
Right, and our mission today is to make sense of that paradox because, I mean, if you look at the headlines right now, global markets are in a state of outright panic over geopolitical conflicts.
They are.
But on the exact same day, if you look under the hood at the underlying financial technology, the actual plumbing of the digital economy, it is maturing and deploying faster than we have ever seen.
To map this out, we are pulling from a really diverse stack of sources.
Yeah, we have a mountain of material to get through.
We do.
We are looking at a breaking market report on today's crypto flash crash from FX leaders, and then Ethereum's newly announced 2026 roadmap from TradingView.
Plus a highly detailed market outlook report from 21 Shares and some brand new regulatory updates on stablecoins from Hunt and Andrews Kurth.
Right. We also have news on a digital currency pilot out in Rwanda from Shinva, and finally, some genuinely eye-opening insights from a Solana media webinar on global payments. Okay, let's unpack this. Starting with the sheer chaos in the markets today, the flash crash.
Yeah, the numbers coming out over the last few hours are staggering.
Insane.
We are talking about $128 billion completely evaporating from the total cryptocurrency market cap in the span of just 1 hour today.
1 hour. Bitcoin plummeted to a midday low of $63,038.
Yeah.
And looking at the FX leaders timeline, the market drop maps perfectly onto today's geopolitical news.
It was an immediate reaction.
Exactly. The moment the U.S. and Israeli military strikes on Iranian nuclear and military targets were confirmed, and Donald Trump announced that troops were being mobilized to Iran, we saw global risk appetite just vanish.
You could see the panic perfectly reflected in the trading data, too. The bearish signals are flashing as bright red as they possibly can.
Yeah.
Funding rates absolutely tanked, dropping to -6%.
So for you listening, if you aren't deep in the day trading weeds, a funding rate is basically the fee traders pay each other to keep their bets open.
Right.
A -6% funding rate essentially means that traders are overwhelmingly betting that the price will continue to fall, and they are willing to pay a massive premium just to keep those short positions open.
They are paying for the privilege of betting against the market.
Exactly.
And it is not just the speculative traders either. We have seen institutional investors pull $4.5 billion out of U.S. spot Bitcoin ETFs just this month.
Which sounds like a textbook mass exodus. But wait, look at the other side of the data.
If we connect this to the bigger picture, the surface-level panic is acting like a smokescreen for a much more resilient underlying structure.
How?
Well, the 21 Shares Market Outlook report makes a highly compelling argument that the famous Bitcoin 4-year cycle is effectively broken.
Oh, wow. For anyone who has followed crypto, that 4-year cycle, the idea that the market reliably booms and busts every 4 years based on the supply halving has been treated like the law of gravity.
It was gospel. The data says it is over. The drawdowns we are seeing now are much shallower than in previous eras.
Even with today's crash?
Even today, in the midst of severe panic, the total drawdown hasn't exceeded 30%. In past cycles, a news event like today's would routinely trigger 60, 70, maybe even 80% corrections.
So the floor is fundamentally higher. Why is the asset stabilizing like that?
This stabilization suggests that Bitcoin is beginning to act much more like a macro hedge against currency debasement.
Let's translate that. Currency debasement is essentially when governments print more fiat money, making the dollars or euros in your pocket worth less.
Exactly that. Because Bitcoin has a fixed supply, institutions are starting to treat it the way they treat gold. It is becoming a safe haven asset during times of systemic risk.
Makes sense.
And the network health metrics back this up entirely. Despite the price volatility today, the Bitcoin network hash rate, which is the total computational power securing the entire network, just breached 1 zettahash.
Which is massive.
It has never been more secure in its history.
And crucially, 18% of all Bitcoin in existence is currently held by governments, public corporations, and ETFs. That is patient capital.
Very patient.
A nation state or a massive corporate treasury doesn't panic sell its strategic reserves on a Saturday afternoon because of a news headline.
Which brings us to the real story here. While the headlines are entirely focused on this price volatility, The tools that are actually moving this patient capital around the globe are experiencing a massive, quiet upgrade.
Yes, I want to pivot away from the market panic and talk about the actual plumbing of global finance, specifically stablecoins, because the growth trajectory here is phenomenal.
It really is.
According to the 21 Shares report, stablecoin supply has already passed $300 billion, and they are projecting it to hit $1 trillion by the end of 2026.
$1 trillion is the threshold where something stops being a tech experiment and becomes foundational global infrastructure. And the regulators are finally catching up to that reality.
They don't have a choice at this scale.
Uh-huh.
This brings us to the Hunt and Andrews Kurth report. Just a few days ago, on February 25th, the Office of the Controller of the Currency, the OCC, published brand new draft regulations for payment stablecoin issuers under the Genius Act.
And they are laying out very specific, rigorous rules of the road.
Like what?
We're talking strict one-to-one reserve requirements, mandatory regular audits, and comprehensive risk management protocols. It applies to national banks, federally licensed non-banks, and even foreign issuers operating in the U.S.
Wow.
And for those listening who want a say in how the future of money is regulated, public comments on these draft regulations are due in 60 days.
That regulatory clarity is the starting gun for traditional finance. We are already seeing massive players like Visa and MasterCard actively integrating stablecoins into their settlement networks.
Stripe is a great example, too.
Yeah, Stripe just reintroduced stablecoin payouts and acquired a company called Bridge, specifically to build out their embedded stablecoin infrastructure.
But when these massive global entities look for the blockchain infrastructure to process all these microtransactions, they're being highly selective about which networks they use.
Right, which brings us to the insights from the Solana media webinar. They broke down why these global payment giants are largely choosing to build on Solana.
It comes down to the brutal math of scale.
Exactly. Solana is currently processing more transactions than all other blockchains combined. They are doing it with fraction of a cent fees, and they achieve sub-second finality.
Sub-second finality is a term that gets thrown around a lot, but for you listening, it simply means the transaction is completely irreversibly settled in less than a second.
Compare that to the traditional banking system. If you are a small business owner, the current system often operates on a T+2 settlement cycle. That means it takes 2 entire business days for the funds from a credit card swipe to actually clear and hit your bank account.
It is the equivalent of upgrading from sending a physical letter through the mail to sending a text message, but for global capital.
I love that analogy.
The webinar highlighted 5 key verticals that this technology is completely redefining right now. First, treasury management. Corporate treasurers are ditching that T+2 settlement for 247 instant liquidity.
Second is remittances. This is huge, replacing expensive correspondent banking with instant, cheap transfers across borders.
Yep.
Third is neobanking, creating new digital wallets that offer native yield and debit cards without the massive overhead of a physical bank.
Fourth is payouts, allowing gig workers, independent contractors, and creators to get paid instantly anywhere on Earth in a currency that holds its value.
Which is vital.
And fifth, merchant settlement, which we just touched on, completely eliminating that painful 3-day wait for a business to receive their operating funds.
But wait, before we assume that public, decentralized blockchains like Solana are going to run the entire world, we have to look at the other side of the coin. There is a very different philosophy playing out concurrently.
You are talking about central bank digital currencies, or CBDCs.
Yes.
Highly centralized, government-controlled digital money. The Xinhua report outlines a fascinating case study playing out in Rwanda.
The National Bank of Rwanda just launched a 12-month CBDC pilot program. And what is brilliant here is their specific focus.
It is very different from the West.
Totally. While the crypto world is obsessing over high-speed algorithmic trading, Rwanda's central bank is laser-focused on grassroots financial inclusion.
They are specifically testing the CBDC using simple USSD channels. For context, USSD is the basic text-based menu system you find on older, non-smart mobile phones. It doesn't require high-speed internet.
They are designing national digital money to reach rural locations and unbanked populations who don't have the latest iPhone or a 5G connection.
Which is incredibly smart.
It proves that there are multiple parallel paths to digitizing a national economy. You have decentralized stablecoins fighting for corporate efficiency in the West, and centralized CBDCs fighting for basic financial inclusion in emerging markets.
And while we are talking about massive infrastructural upgrades, we have to look at what is happening with the second largest network in the world, Ethereum.
This is a classic divergence between price action and fundamental network development.
Yes, it is.
Right now, according to TradingView, Ethereum is trading bearishly, slipping under the $2,000 mark. But if you look at the institutional behavior, the story flips.
Completely flips.
Just on February 25th, spot Ethereum ETF saw over $157 million in net inflows. And publicly traded companies like Bitmine Immersion Technologies are currently holding a massive 4.42 million ETH in their treasury. They're aggressively buying while the retail market is fearful.
They are accumulating because they are looking at the technical horizon.
Yes, the Glamsterdam hard fork, which honestly sounds like a 1970s glam rock band, but is actually a massive technical overhaul that Vitalik Buterin just outlined for the first half of 2026.
It is a major update.
I read the headlines about gas fees dropping, but I have to admit, the technical specifics went a bit over my head. What is actually changing under the hood here?
It incorporates 8 distinct Ethereum improvement proposals, but the major takeaways for a non-developer are twofold. First, they are introducing parallel block verification.
Yeah, okay, what does that mean practically?
Think of the current network like a single checkout lane at a grocery store. Everyone waits in one line. Parallel verification opens up a dozen lanes, allowing the network to process multiple complex tasks simultaneously.
Oh, that makes perfect sense. And the second takeaway?
The real headline for everyday users is the cost. Gas fees, which are essentially the digital postage stamps you buy to process a transaction on Ethereum, are projected to see a massive 78.6% drop for smart contracts.
That is a game changer for usability.
What's fascinating here is how this mainnet upgrade actually devastates the surrounding ecosystem.
Yeah.
Because right now, the Ethereum Layer 2 ecosystem is facing a brutal reality check. The 21 Shares report paints a picture of an absolute bloodbath.
So let's translate layer 2 or L2 for a second. These are the side networks built on top of Ethereum to bundle transactions together, often called roll-ups, to make things faster and cheaper, right?
Correct. But we have hit a massive saturation point. We had a period of wild proliferation where dozens of these Layer 2 networks launched, all promising to be the fastest and cheapest.
And now?
But now we are seeing aggressive, unforgiving consolidation. 3 networks, Base, Arbitrum, and Optimism, are now processing nearly 90% of all L2 transactions.
Wow. 3 networks are eating 90% of the pie, and dozens of others are starving, fighting over the remaining 10%.
The casualties are piling up fast. Networks like Kinto have shut down completely. A heavily hiked network called Blast saw its total value locked completely collapse by 97%.
How did it go so wrong for them so quickly?
The irony is that previous Ethereum upgrades made data storage so cheap that it triggered a race-to-the-bottom fee war among these Layer 2s. If you charge 0 fees to attract users, you need unimaginable volume to stay afloat. Now, almost all of these rollups are operating unprofitably.
Except for Base, I assume.
Base, which is backed by Coinbase, is the notable exception. They actually earned around $55 million. But for the rest of the pack, 2026 is looking like an extinction-level event for smaller scaling solutions.
That is brutal.
It is very much like the early days of the internet, 1,000 search engines launch, but eventually the market decides it only really needs Google.
Okay, let's move from the infrastructure level up to the application layer. Here's where it gets really interesting, because the way you and I actually interact with all of this financial technology is about to change fundamentally. We are entering what the 21 Shares report calls the agentic economy.
This is perhaps the most transformative, paradigm-shifting concept we are discussing today.
It is wild. For you listening, think about how you manage your money right now. You log into an app, you look at a chart, you manually move funds, maybe you hunt around for a better interest rate.
Right.
The agentic economy completely removes you from that process. Instead of you personally managing your crypto, you hire an AI agent to do it for you.
You give the AI a risk profile, say moderate risk, targeting an 8% yield, and the AI autonomously optimizes your decentralized finance strategies across different blockchains in real time. It is moving from programmable money to programmable intelligence.
I want to paint a picture of what this actually looks like. Imagine your AI agent is scanning global data and notices that the weather in Brazil is unexpectedly freezing, predicting a massive coffee shortage.
A very real scenario.
Right. In milliseconds, it uses a stablecoin to buy coffee futures on a decentralized exchange, hedges your broader portfolio against inflation, and secures a profit. It secures a profit before you have even woken up and had your own cup of coffee.
And to facilitate that level of automation, these machines need a way to transact with each other.
Because they can't open a traditional bank account.
Exactly.
Yeah.
A human bank account requires a social security number, KYC checks, and days to open. A machine can't do that.
No.
So platforms like Infinite, Giza, and Almanac are building this out. And Coinbase just introduced a protocol called Buy402. It allows for account-free, machine-to-machine payments.
That is huge.
Literally, an AI agent can pay another AI agent for computing power, satellite imagery, or data instantly without ever needing human approval.
The insight here is that human day traders are suddenly going to be competing against algorithms that do not sleep, do not feel fear, and can process global weather patterns in milliseconds.
If we connect this automation to another massive trend we are seeing, the implications become almost incomprehensible. I am talking about the explosion of prediction markets.
Oh, right. These are platforms where you can place financial bets on the outcome of real-world events, right?
Yes, but calling them bets almost trivializes what they are becoming. Prediction markets are essentially taking the concept of financial derivatives and applying them to reality itself.
They are crowdsourced proof engine.
Precisely. Platforms like Polymarket and Kalshi are expected to hit $100 billion in trading volume.
And this isn't just retail users gambling on pop culture. The Intercontinental Exchange, ICE, the massive company that literally owns the New York Stock Exchange, just made a $2 billion commitment to scale Polymarket.
$2 billion from the owners of the NYSE completely validates the space. They clearly see prediction markets as the future of real-time data and forecasting, because when you put real money on the line, the accuracy of the crowd's prediction skyrockets.
It is a total paradigm shift. And speaking of old paradigms becoming new again, we are seeing the return of the IC of the initial coin offering. But as the 21 Shares report notes, this time it is heavily regulated.
The ICO boom back in 2017 was notorious for scams, empty promises, and a complete lack of regulatory oversight. This new wave is entirely different. It is capital markets 2.0.
Retail investors are finally getting safe, compliant access to early-stage startups through platforms like Legion and Echo. In fact, Coinbase just acquired Echo for $375 million to build out this exact capability.
We just saw a project called Monad raise $216 million through this new regulated framework.
It allows everyday people to participate in the venture capital game that was previously walled off for accredited millionaires.
And rounding out this market outlook, we have to touch on tokenized real-world assets, or RWAs. This sector is projected to hit $500 billion in total value locked.
$500 billion. What is the driving force behind that massive number?
It is primarily driven by private credit and the tokenization of pre-IPO equities. Wall Street institutions are realizing that putting traditional, illiquid assets on a blockchain allows for instant settlement, 24/7 in trading, and global liquidity. They are quite literally moving traditional corporate balance sheets on-chain.
So, what does this all mean? Let's bring this all together for you. If you are sitting there listening, perhaps watching the news today, seeing the markets bleed because of the conflict in the Middle East, seeing negative funding rates and ETF outflows, it is incredibly easy to feel overwhelmed by the volatility.
It really is.
But the core takeaway from all of these sources is this. The deafening noise of flash crashes and geopolitical anxiety is acting as a smokescreen. Behind that smokescreen, there is a massive, highly coordinated and quiet upgrade happening to the actual plumbing of global finance.
A profound structural shift.
We are moving away from an era of pure speculation. We are entering an era of programmable intelligence, institutional-grade stablecoins moving trillions of dollars, regulated capital formation, and instant global settlement. The foundation is being poured right now, today, even while the surface level looks chaotic.
And looking at all these pieces together, this raises an important question. One that wasn't explicitly stated in our reports today, but is the logical, unavoidable conclusion of everything we've just discussed.
I am listening.
Consider this scenario. We know that prediction markets are currently turning real-world geopolitical events, like the very strikes in the Middle East that crash the market today, into highly liquid, real-time data feeds.
Right.
And we know that AI agents in this new agentic economy are now fully capable of executing complex, autonomous financial strategies in milliseconds using machine-to-machine payments.
Yeah.
So what happens to the global economy when machine intelligence starts instantly trading on the outbreak of war? What happens when millions of AI agents execute highly complex decentralized finance strategies, hedging portfolios, and moving billions of dollars across borders before the breaking news even reaches human eyes?
That is a heavy and frankly terrifying thought to leave you with. Thank you so much for joining us for this deep dive into the underlying currents of the global economy. Keep questioning the information around you, look past the headlines, and we will catch you next time.